China's real estate sector has long been seen as a pillar of the country's economy, driving growth and prosperity. However, recent warnings from experts suggest that this once solid foundation could be cracking, with the potential to cause a crisis more severe than the 2008 US crash. Let's explore the factors contributing to China's real estate crisis and the dire consequences that could follow a collapse in the housing market. Economists are worried that China's heavy reliance on real estate could lead to a financial crisis similar to what happened in the US in 2008. It's a concerning situation that could have far-reaching consequences for the global economy. This is just like the US financial crisis on steroids, the Heyman Capital founder said. They have 3.5 times more banking leverage than we did going into the crisis, and they've only been at this banking thing for a couple of decades. China's economic growth in recent years was primarily attributed to the unregulated real estate market, which heavily relied on debt for expansion. However, the recent surge in defaults could pose a significant threat to the overall economy. Considering that the real estate industry contributes about a quarter of the country's GDP and 70% of household wealth, it's essential to address this issue before it's too late. The current state of the Chinese economy is worrisome, as the basic architecture seems to be failing. Most public or listed Chinese developers are in default, and even the largest ones, such as Evergrande and Country Garden, have a collective debt of over $500 billion. Unfortunately, Evergrande's liquidation in January has raised concerns about the possibility of more systemic risks in the future. It's important to note that the US banking system lost about $800 billion during the financial crisis, which was later resolved through fresh capital injection. However, Chinese officials have hesitated to offer the same economic stimulus in response to the current crisis. The financial strain on local governments is feared due to defaults leading to decreased revenue from land sales to developers. The local government debt marketplace is now equivalent to $13 trillion. The economic stress in China has had a profound impact on its markets, which have witnessed a staggering loss of $7 trillion since 2021. Despite the recent efforts made by the Beijing authorities to curtail this trend, the confidence of investors and traders remains low. The US subprime mortgage crisis serves as a grave reminder of the potential dangers that a deteriorating housing market can bring. According to Goldman Sachs analysts, history has shown that such markets can take quite a while to reach a bottom once they start to decline. Their warning highlights the importance of staying vigilant in any potential market downturns. We estimate that real house prices in China declined 16% from the peak in 2021 Q3 to 2023 Q3, Goldman analysts said. If the US experience is of any guidance, we are only halfway through the downward price adjustment in the current housing downturn. The financial situation seems to be falling apart for many as the stock investments have plummeted by a whopping 30%. To add to the misery, the salary package has been slashed by 30%, and property investments have taken a massive hit, reducing to a mere 20%. With the year 2023 lurking around the corner, people involved in small-scale businesses are left pondering over their dwindling household finances, fearing the worst. Being in the financial market is tough, and the future looks bleak. The middle class in China is facing a challenging situation that many can relate to. Recent slumps in the real estate and stock markets have resulted in the loss of household wealth. Additionally, COVID-19 lockdowns have left the world's second-largest economy struggling to regain momentum, leading to a growing threat of unemployment. As a result, middle-class households are forced to reconsider their financial priorities. Many opt to liquidate assets and refrain from investing to free up liquidity. It's a difficult but necessary situation to weather these uncertain times. China's real estate market crash is taking a heavy toll on families' wealth, as 70% of their assets are tied up in property. Shockingly, a mere 5% decrease in home prices can erase an enormous 19 trillion yuan, $2.7 trillion, in housing wealth. This situation calls for a closer look at current affairs and the need for a comprehensive solution to prevent further loss of family wealth. It might just be the beginning of more wealth losses in coming years, said Eric Zhu, an economist with Bloomberg Economics. Unless there's a big bull market, small gains in financial wealth are unlikely to offset losses in housing wealth. China's official data suggest a minor decline in home prices, but the reality may be far more severe. According to property agents and private data providers, prime areas in the country's major cities have experienced drops of no less than 15%. These findings suggest that the housing market may be more precarious than the official figures suggest. It's been reported that the housing sector may reduce its value from 20% to 16% of China's GDP by 2026, as stated by Bloomberg Economics. This could affect the livelihoods of about 5 million individuals, equivalent to 1% of the urban workforce, leading to unemployment or decreased earnings. We must take note of this situation and consider taking necessary steps to prevent the economic fallout. Chinese shares have been underperforming emerging market peers by the widest margin since at least 1998, making financial investments a less appealing option. Mutual funds were red in the third quarter, while yields on banks' wealth management products remain subdued. Deposit rates have seen 3 reductions in the past year, resulting in a challenging situation for investors. Additionally, the $2.9 trillion trust industry, which wealthy Chinese investors had relied on for high returns, is now showing cracks. A recent scandal has potentially resulted in tens of billions of dollars in losses. Given these circumstances, reconsidering financial investments and exploring other options may be wise. According to UBS's August Global Wealth Report, China's net worth per adult has decreased by 2.2% to $75,731 in 2022. This is the first time since 2000 that the total assets per adult have fallen due to housing market difficulties and the shrinking of non-financial holdings. Echo Huang, a media worker, had to witness the value of her investment property in Ningbo, Zhejiang Province, fall by approximately 1 million yuan from its peak in 2019. Fortunately, she could sell it in May before the prices dropped even further. Huang's thoughtful financial planning is something we can all learn from. She generously used most of the proceeds from her property sale to help secure her parents' retirement savings. Given the unpredictable nature of the current economy, she wisely invested the rest in demand deposits and money market funds that offer real-time redemptions. Huang also made a wise decision to steer clear of stock investments after experiencing substantial losses. As her company struggles to survive, Huang recognizes the importance of maintaining stable assets and having enough liquidity. Her proactive approach to financial management is commendable and an example for us all. Did you know that even high net worth individuals are turning more conservative with their money? A joint survey by China Merchants Bank Company and Bain & Company revealed that wealth protection has become a primary money goal for many, with mentions of wealth creation decreasing. It's more than just the wealthy taking a more prudent approach to investing. People like Peter Bao, who works at a big technology firm in Beijing, understand the importance of a conservative investment strategy. Don't let your hard-earned money slip away. Ensure you're protecting your wealth. He faced a significant drop in his stock holdings throughout the past year, predominantly in US-listed Chinese shares. From a peak in late 2020, his holdings were halved to about 5 million yuan. However, he didn't let this setback hold him back. Instead, he shifted some of his assets to money market funds and fixed income products that require less analysis. His wise move will help him withstand short-term volatility and potential losses. With his intelligent financial planning, he's confident he'll be able to navigate any future financial challenges. China's economic growth has been a topic of interest for many analysts and investors, and it seems that the country is on track to achieve its target growth rate of approximately 5% for 2023. However, concerns linger about the potential impact of deflation risks, a housing crisis, and the ongoing confidence crunch that may hinder the economy's momentum in the coming year. According to the latest data, China's gross domestic product is expected to have expanded by 5.2% in 2022, indicating that the country has made significant progress toward its growth goal. However, there is some indication that the economy may have slowed down in the year's fourth quarter. Despite this, retail sales and industrial output are forecasted to continue growing in December, compared to the same period in the previous year, despite the low base of comparison, as the country was still grappling with the massive COVID-19 outbreak in late 2022. Investors and economists will closely watch these trends as they provide insights into the overall health and resilience of the Chinese economy in the face of ongoing challenges. The beginning of the year has presented us with a range of positive and negative news. On the one hand, consumer prices in China have fallen for 3 consecutive months, marking their longest deflation streak since 2009. On the other hand, exports display signs of stabilization despite a continuous decline throughout 2023, the first since 2016. The domestic demand recovery will be slow and bumpy as targeted stimulus measures trickle through to investment sectors and the property recovery proceeds at a snail-like pace, said Duncan Wrigley, chief China economist at Pantheon Macroeconomics. On Monday, the People's Bank of China has a critical chance to counter the looming threat of deflationary pressures while also boosting lending. Leading economists surveyed by Bloomberg are broadly expecting the central bank to decrease the rate on its one-year policy loans by 10 basis points, bringing it down to 2.4%. Additionally, policymakers are expected to inject more funds into the financial system. Take advantage of this opportunity to take the necessary steps towards a more stable economic future. China's current real estate crisis can become a much bigger problem than the 2008 financial crisis. While the government is taking action, the situation remains uncertain, and investors, consumers, and governments alike need to approach the situation cautiously to avoid any potential ripple effects. However, some experts are questioning the efficacy of Beijing's tools to maintain a delicate balance between providing support to the housing market and keeping debt levels in check. It's crucial to stay informed and aware of the latest developments to navigate these challenging times.